So the next one we're going to talk about is bad theory. And this is one of the reasons that 95% of money managers can't outperform the S&P 500. They've been taught in university a flawed and false and proven wrong theory, and they operate their funds and investment choices on this theory. It is very strongly disproven and easy to prove to all of you that it's wrong. They're taught something called modern portfolio theory and also efficient market hypothesis. And there's a couple of other things that's bad theories that they use, but let's talk about that quickly and we can do the other ones next. So the part that is wrong about what I just mentioned is that the theory they're taught is that all businesses are priced accurately at all times, that the price is the value, that we're all together somehow capable of correctly valuing a business and correctly estimating the risk and pricing into the price everything we need to know about the business perfectly, and they operate thinking that the price and the value are the same thing. And there is a massive flaw in that. It sounds wonderful, but we're not machines, we're not perfect. We tend to move on emotion and false information, and we tend to follow the crowd. We have a lot of different biases and a lot of different psychological principles at play. And because of that, stocks can be grossly overvalued and they can be grossly undervalued. And it's super easy to prove that when you look at the overreactions of the market. And also, individual companies, when the price gets halved, the value of the business didn't get halved in a day. And the value is connected to the cash flow and the risks of the business. And as value investors, ask any value investor, the prices are not perfect all the time. And it's the same with everything in the world. You've all seen, a house that's overpriced or a house that's underpriced. We can see that there are different accuracies, and that's one of the big reasons I think that they fail, is because they are operating thinking that price is equal to value. Your thoughts on this particular one, Eugene?
Most people just try to overcomplicate stuff, so they just try to look on different indicators, modern theories, but in general, it's just buying the discounted assets, knowing that they are good. And in order to do that, you need to really understand the business. You need to really understand the accounting principles, like what is the balance sheet, how to read it, how to read cash flow, how to read income statement, and how to understand people and know the circle of competence of yours.
So on a similar note, we'll discuss some other theories that they have wrong. The next point I wanted to make was about diversification. So essentially, they have this sort of idea in their heads that safety and diversification are the same thing. And I want to explain why they are over-diversifying to a very high degree. If you go to a garage sale and you're an expert in watches or you're an expert in fur coats, you're going to look at those items in the garage sale and you'll know what you're buying. You'll know if it's a good deal. You'll know if you can sell it for more in 2 days' time down the road, because you're an expert in that thing and you've really looked at that particular item in detail and you know what you're buying. And that is what us value investors do. We know what we're buying, we know what it's worth, and we know if it's a good deal or not. Now, over diversification would be going into the garage sale, and buying everything in the garage without looking at it in detail, without understanding it, without valuing it, and imagining that you're going to do well. And of course, you don't do as well. And that's what most money managers do. Ask your money manager or any money manager how many stocks they recommend be in your portfolio, how many companies. And I think you'll find that most of them will be in the hundreds or thousands, which is impossible for them to know each company, what they do, what the numbers mean, if they're overpriced or underpriced. They're just buying everything. And with that, you're going to get a pretty horrible result. and that's what has been proven to be the case. What's your thoughts on that, Eugene?
Probably some of our audience know that the great guy Charlie Munger has only two stocks, which are Costco and Berkshire Hathaway, and he has also some rental apartment, and that's all. And he says that he is plenty diversified.
So two thoughts on that. One, Charlie Munger is very diversified, because buying a company like Berkshire Hathaway or one of the big ones on the Dow Jones Industrial Average, you are plenty diversified just buying one, because those are super companies. And by super companies, I don't mean they're wonderful. I mean that they're 50 or 100 companies under them, and that's plenty diversified. Berkshire Hathaway, I believe, has over 70 different companies, and so that is very diversified. Ordinarily, I don't like to do that, because I would have to research each of those companies to know what I'm buying. There's various reasons it's important for me to know each and every company. We'll get into that later. But one of the things that I'll mention briefly, I'll give it more detail in a future episode about diversification. But somebody famous, I'll get into that in that episode. He misses my mind right now, but he did a huge study, and he proved that you are something like 90% diversified in just 16 stocks or something like that. And so you don't need hundreds or thousands to be diversified. And a lot of value investors believe having 8 different companies that are in different geographical regions or in different industries or sectors is plenty diversification as well. And so there is that to think about. Your thoughts?
We want to be over concentrated into several stocks, which we really understand. And if we just buy them at a decent price, we really know that the management is great, the business is great itself, we can be plenty diversified as well.
Other things that really affect the returns of these money managers, one of the things that makes them underperform people like you and I, they are dealing with such large amounts of money that it can take up to 12 weeks to get into one position on a company. Because if you're moving $50 million, if you put it all in one day, you're going to affect the price dramatically. The first hour that you put in that much money, you're trying to make all those sales, you're moving the market, you're moving the price. And so therefore, you're forcing yourself to pay a higher price the faster you get in to the market, because you're effectively so much high demand that there isn't enough people wanting to sell, and so you're pushing the price up. So if you're a large investor, you have to take time to sneak into that stock to not push the price up, and that can take 12 weeks. And by then, anything could have happened to the stock as well. Us small investors, we are nimble, and I mean, you can be nimble with even $1 million, but when you're talking about 50 million, 100 million, $1 billion, you can't really move as quick and nimble as you could as a small investor. And that really affects things. And when you pair that with some of these other things, it compounds and really affects your returns. What are your thoughts on that?
When you increase the amount of money you manage, you just go on the next level. And you cannot invest in companies with a small cap like 20 million, 30 million, if you're already managing 100 billion or $1 billion, because even if you buy 20-30% of the company and the company will move 50-100%, it doesn't affect the whole your portfolio performance. As a result, you won't get as the same benefit as you would invest the 10%, 15% of your portfolio, and it will move up by 15-20%.
That's definitely a big point as to why they cannot outperform the market, and also why we can outperform them. One of the things that really makes a big difference, and I think is probably one of the most critical aspects of making good returns, is to not let your emotion guide your decisions. And it doesn't matter if you're managing $1 billion or $1,000. Emotion is the biggest enemy of good returns and rational thinking, and it affects everyone. No matter if you're if you're a top fund manager, or they have the same emotions you do, and if they haven't learned to control it, and if they're being affected by it, then they are making mistakes, because you cannot base your financial decisions, your returns, on how you're feeling. You need to make decisions based on the facts. And so we can have an advantage over every investor in the world if our emotions are in check and theirs are not. So that is one of the biggest points we need to focus on. Your thoughts?
Most hedge fund managers just want to overbeat the competitor, which is their co-worker or their friend from different fund, or just their average asset or index, etc. And by that, they implement emotions into their work, and they try to make or hasty decisions or just move faster. But in value investing, it doesn't work that way as well. This can also be useful in the times like today, when we have such negative economic effects. We have different conflicts around the world, and people just scary about owning some kind of stocks. And usually these emotions that go before in front of them, and they just sell these positions, even though they logically great, and from the financial point, they profit companies.
I'm sure that many of our viewers have heard about things like meme stock bubbles, and I think we should go into that briefly now, but more heavily in a future episode. But one of the points is that bubbles and meme stock and that kind of thing, it's people following the trend. It's people trying to ride the wave of emotion, of people getting caught up in things and excited, and they see people doing well next to them, and so they want a piece of it, and they jump in because of it, and they're not looking at, is it a good company? What's the good price of the company? They're just kind of gambling and wanting to be part of this thing that they don't fully understand. And I think that's a large danger. Sort of wind up this topic of why money managers, 95% of them can't beat the market, and why we can. I wanted to prove in under 2 minutes how anyone can beat the market and therefore be in the top 5% of investors. And that is a big boast. Let's see if I can deliver. 2 minutes, how anyone can beat the market. And now I'm not suggesting that you do this, and I'm not your financial advisor, and this is for education and entertainment only. But I wanted to prove conceptually how easy it is to beat the market. And then you wonder how these 95% of money managers have not been able to do so. So the S&P 500 is how we judge the market. It is the number one way. What it is it's a group of the top 500 companies in America as chosen by certain criteria. And it typically follows what the entire market is doing in a very easy sort of fashion. And each company is weighted a certain amount. So if you were to put $1,000 into the S&P 500, it wouldn't go equally to every company. It would go according to a certain weightedness, which has been decided based on market cap, I believe. And so how to beat the S&P 500's returns is simple. First, you create a spreadsheet, and then you put a list of all the companies that are in the S&P 500, and that's available on the S&P 500 website. And you put in the next column the weightedness of each company. And theoretically, if you were to buy each of those companies at those percentages with your money, exactly the same as if you bought SPY or VOO or any other ETF that tracks the S&P 500. So how to beat the S&P 500 is simple. All you need to do is look at each of the companies and remove the one that looks like it is going to do terribly next year. One of those companies has been going down for 5 years, probably several of them. And so you can predict with fairly high accuracy that they're going to do terribly next year as well. And so if you remove just one company that's doing badly, your returns as a whole will be slightly better than the S&P 500. ta-da, you've just beaten the market. And obviously you can take it a little bit further and remove the 10 worst companies, or the 20, or the 100. You can get more complicated with it, and you can remove all the ones that look like they might go bankrupt using the Altman Z-score, and so on and so forth. Simply removing the ones that are going to do poorly, keeping the ones that have proven over the last 5 years to do well, your odds of beating the S&P 500 are staggeringly high. This is not something I suggest doing, but it's a good intellectual exercise just to prove that these 95% of money managers should probably all lose their jobs because they're underperforming the market when it's so easy to outperform the market. I'll leave it over to you, Eugene. You can give your thoughts and also close up this episode.
And this is the great explanation and a great show and exercise, as you said previously, to understand how the market works. And of course, you need to understand the companies which you are investing. This is the basic principle, and the buy at the fair price. But anyway, this is the end of this episode. We hope that you really enjoyed it. And we will see you next time speaking about finance, investing, and business. So bye.